And there is no true alternative to the US stock market for equity investors, as seen by the stagflation crisis in Europe and the property slowdown in China. With just 4 months remaining in 2023, the S&P 500's gains are ahead of the Stoxx Europe 600 by nearly 8 percentage points. The S&P index is on track for the 8th year of outperformance in the previous decade as AI hype overshadows recession worries and also high valuations. Meanwhile, the Federal Reserve's efforts to control inflation while maintaining economic growth have been successful. Friday's data showed an uptick in hiring and a small deceleration in pay growth, both of which are consistent with a soft landing. Well, in contrast, if interest rates are allowed to rise, Europe might see stagflation similar to that of the 1970s, with the economy contracting and inflation exceeding 5% when comparing price to earnings ratios. The Stoxx 600 in Europe is trading at an historic low compared to the S&P 500. Well, according to some market experts, such as Citigroup's David Groman, it means that Europe is factoring in the negative news. Now, in July, Citi became more bullish on Europe and less bullish on the United States of America. However, the stock valuation argument is gaining less traction in the economies that are worried about stagflation. This year, luxury firms like LVMH and Hermes International have contributed majorly to equities returns in Europe, mirroring the performance of American high-growth, high-value technology corporations. However, the downturn in China is a challenge for such brands since the country is responsible for as much as 20% of their yearly revenue. The Hang Seng Index was the weakest performance last month out of 92 indices monitoring by Bloomberg, indicating that China's woes persist deep despite an interest rate decrease and attempt to lift mortgage regulations. According to Bloomberg data, the overseas investors dumped mainland Chinese equities worth around $12.3 billion in August. More generally, the gloomy future for consumers in China and Europe provides bulls on Wall Street with yet another reason to remain invested in the US market. That is, when inflation-adjusted consumer spending increased by a robust 0.6% last month, thanks to the strength of the labor market.